Good evening, ladies and gentlemen, and thank you for attending our mid-year market briefing. So for the second half of 2012, we're here to talk about why it's more fun investing in the Philippines. Okay, for those of you who have been invested in the Philippines, I'm sure you've had more fun than our global peers. So for the first half, or actually for the year-to-date period ending last week, our market was up by around 18.5%. In contrast, you have the US up by only 8.4%. China is actually down by 1.4% for the same period, whereas the European nations are down by an average of 5.6%. Okay, so the Philippines went up by 18.5% despite all the bad news coming out of Europe, US, and China. Okay, so let us take a look at why. So I think one of the most important indicators that you can look at is the GDP. So during the first quarter, you can see here that the Philippines actually surprised positively, delivering a GDP growth of 6.4%. So if you look at 6.4% as compared to our growth during the past 5 years, and also as compared to 2011, it's actually much faster. In contrast, you see the other countries either slowing down, or the US was up compared to the five-year average and compared to 2011. But the problem is this second quarter, indications show that it might actually slow down in terms of GDP growth. But as far as the Philippines is concerned, it's still doing very well. Okay, so what were the drivers of the strong GDP growth of the Philippines? You have your consumer spending accelerating. So consumers, the spending growth grew by 6.6%. You have government actually keeping its promise of increasing its spending. So during the first quarter, government spending was up by 24%. And then you have exports surprising positively despite all the bad news coming out of US, Europe, and China. Our exports actually picked up by 7.9% during the first quarter. So it was a very strong first quarter for the Philippine economy. We believe that the outlook remains favorable for the second half and for 2013, given the following factors. First, we expect consumer spending growth to remain resilient. Next, our government, we are confident that our government is ready and willing to continue increasing its spending. Next, the PPP projects, we believe, will start to gain momentum for the second half and for 2013. And the mining industry, we believe, is in the process of ensuring sustainable growth in the coming years. Okay, one of the reasons why we believe that consumer spending growth will remain resilient is because of strong growth in OFW remittances and BPO revenues. So you can see that despite the problems overseas, our OFW remittances continue to go up. So for the first 5 months of the year, OFW remittances still grew by 5.3%. And our BPO revenues last year was up by more than 20%. Okay, I'm sure if you have friends who are leasing out their properties for offices, they can attest to how strong the demand is for office properties coming out of the BPO space. And we believe that the strength of the BPO industry and OFW remittances will continue. This is because of the significant wage differential of the Philippines relative to our peers. Okay, so admittedly, our minimum wage is higher compared to countries such as Cambodia, Vietnam, Indonesia, China, and Thailand. But in the same respect, they are not as good as we are when it comes to English. But if you compare our wages also to the other countries, so what we've done here is we've chosen the top destinations for Filipinos where they usually go to as OFWs. And as you can see, the differential is quite substantial. So even if the peso strengthens, we believe that the trend of Filipinos going overseas and trying to seek better wages will continue because of this huge wage differential that we see. Okay, another reason why we believe consumer spending will remain resilient is because of our favorable demographic. We have a very young population, okay, and it's also growing. So our population is actually growing by 1.9%, meaning that demand actually increases by 1.9% on an annual basis. And aside from that, you have a young population of 22, with an average age of 22.9. This means that our people are just going to start working, the spending power is going to increase, therefore they will definitely spend more. So this is very favorable for consumer spending. Next, another driver for consumer spending, we believe, is falling commodity prices. So as commodity prices fall, for example, as oil prices go down, consumers will have more purchasing power for other goods. Okay? So although currently we're seeing some pressure on prices of corn and other agricultural products, we think on a longer term basis, the likelihood that it will stay elevated is very minimal because of the slowdown in the global economy. Most likely oil prices will, and other commodities will, the price will remain low because of the slowdown that we're seeing in the global economy. And this should be favorable for our consumers. Okay, next, let's move on to the government. We believe that our government is ready and willing to spend. So while we are hearing a lot of news coming out of Europe that the governments there are, the debt levels of the governments in Europe are picking up, you can see that in the Philippines, our debt levels are actually falling relative to our GDP ratio. So from a peak of around 78%, it's expected to drop to around 48.6% by 2013. And this is despite the government's plans to actually increase their spending. Okay, so what has the government done so far? Why is 2012 such a strong year for government spending? Okay, so during the start of the year, the government said that it is targeting to increase spending by around 18%. Okay. So far, for the year-to-date period ending May, spending is actually up by 13.1%. So the government has said that it is quite confident that it can meet the target because as of end June, the Department of Budget and Management said that it has already released 74.9% of the 2012 national budget, meaning that most likely those that have the agencies that have been given a budget to spend will have the capacity to spend the money. And the positive thing is, if you look at the revenue side, revenues have been growing to actually fund the spending. Okay, tax revenues have been going up. This is due to better collections by the government. So for 2013 looks good again. Okay, although government spending is set to increase by 10.5%, I'd like to focus on the spending on infrastructure. Okay, infrastructure spending will increase by 20.8%, which is quite substantial. Okay, economic and social services, the spending will increase by 14.9%. And the reason why the government can afford this is because the budget that it will allocate for servicing its debts will actually be almost flat. So the money that will be freed up will be spent for more essential items that will fuel economic growth for the Philippines. Okay, and finally, we are quite confident that the budget will be passed early again this year, 2013. So prior to 2012, the last time that the budget was passed on time was in 1999. Okay, but looks like 2013 will see another on-time passage of the budget. And this is very critical so that the government agencies can actually start their spending early on in the year. Here I've just attached the budget preparation and legislation flowchart to show you where we are. Okay, before the budget is passed, it has to go through this process, this long process. And right now, the President's budget has already been passed and we are already at the House deliberations. Okay, so from there, I think it will be easy for the budget to be passed around December and implementation to start in January, which is very important. Okay. And then next are PPP projects. I think one of the criticisms that you hear so much is that, you know, it's taking forever for these PPPs to materialize. I mean, what's the status? In fact, some of them call PPP PowerPoint pa lang kasi puro salita, di ba? So anyway, so what's taking the PPP so long? We went to the PPP website and it explained to us the process of how PPPs are implemented, or what's the whole process about. So the PPP projects go through 5 steps. So the first 2 steps are the business case feasibility study preparation and the project review and evaluation and approval are the processes that take a long time. But the moment a PPP project reaches step 3, which is the publication of invitation to pre-qualify and bid, they said that from step 3 to step 5, it will only take 6 months. So at least that would speed things up a bit. Okay, so in light of that, we checked all the projects that they posted in the PPP website, and from there, we think that around 55 billion pesos worth of projects will most likely be awarded for the second half of 2012. So these projects are those that are already in step 3 to step 5. Okay. So this year, most likely, the size of the PPP projects to be awarded will be 55 billion. But for next year, the list of projects is actually much bigger at around 112.5 billion at least. So it's quite substantial. Putting everything into context, okay, we think that PPP really could be a growth driver because in 2011, you only had 2 billion pesos worth of PPP projects. Let's say this year, it's 55 billion. Next year, it's 112. So you see the contribution actually picking up, and PPP will be a substantial growth driver in that respect. The mining industry, so why is the mining industry something to be excited about over the longer term? How can it affect our economic growth? Well, the mining industry has a huge potential in this country. So according to estimates, 9 million hectares out of the 30 million hectares in our country have high mineral potential. And the estimated value of reserves in the country is around $1 trillion US. And the government, well, is planning to increase the size of investments in the mining industry from only 4.4 billion during the past 8 years, from 2004 to 2011. For the next 5 years, they want this value to grow to $12 billion US. So that's a big jump. It's almost 300%. Okay, so what about EO 79? There are a lot of criticisms about it. Admittedly, there are some negatives, but we think the positives will outweigh the negatives. So what are the negatives? First, there will be delays. According to the law, no mining permits will be awarded until a law on the revenue sharing scheme is passed. Okay, and then, of course, the cost will go up for mining companies because from a 2% revenue share, the government wants to increase the share to between 5 to 7%. But on the positive side, we believe that EO 79 will pave the way for sustainable growth, sustainable investments. Okay. One of the criticisms in the mining sector why investors are not coming in is because of all the red tape and the confusion as to who they need to talk to. So with the mining EO 79, what will happen is it will be centralized. You have to only talk to the national government, and then the national government, with the increased size of revenues that it will get from the mining companies, will just distribute the earnings to the local governments and the other agencies that right now all these investors have to talk to. So in light of that, more investors are expected to be attracted to the mining industry. Next, environmental protection is emphasized. So certain areas have been identified as areas that cannot be mined. Okay, so that should be good. It will allow us to protect our environment. Okay, and there will be incentives for investments in higher value-added processes. So right now, I'm sure you are aware that most mining companies, what they do is they just extract the ore from our mines, and then what they do is they ship it out to different countries to be processed into the end products, or turn maybe to the, let's say, to gold or copper. But realistically, that's where the employment is generated. That is where most of the money is made, not in the extraction of the ore. So what the government wants to happen is for these companies to set up the factories, to set up the processing plants, so that more Filipinos actually will be given jobs and for economic growth to pick up. And we're quite positive about that. Aside from those factors that we discussed, there have been an abundance of favorable developments which make us very, very positive for the second half of 2012 and for 2013. So first of all, S&P earlier this month upgraded the Philippines credit rating, and it's just one notch lower than investment grade. Okay, bank lending grew by 14.7% in May. So it's an indication that companies are actually ramping up their investments. Okay, power consumption was up by 8.5% during the second quarter of 2012, and this is according to Meralco. Okay, so we're quite positive. It's another indication that economic activity is picking up. And then, surprisingly, exports were up by 19.7% in May. We were quite positively surprised that exports managed to pick up. We initially thought that this was a low base effect. But then when we checked last year's number, it's not a low base effect. There's really something going on as far as exports are concerned. We're quite happy with the numbers. And in fact, exports to Europe still went up for the month of May, despite all the problems there. Okay, later on, Mr. Lee, our chairman, will discuss or will show more indicators that we are still in the early stage of the cycle. I think there is a lot of concern that we are reaching the end stages of the market cycle and we could be in a bubble phase. But I'd like to show you some indicators here that prove that we're still very early in the cycle. Okay. When I do my lectures on fundamental analysis and presentations, I usually tell the clients or tell my students that during the peak phase of an economic cycle, one of the manifestations will be high level of debts. So as you can see here, loan levels are not yet up significantly. Admittedly, it's been picking up, but look at the loans to GDP. During the time of the Asian financial crisis, loans to GDP hit a peak of 58%, and it's now just 31%. Still a long way to go. Our consumers, admittedly, maybe have more access to borrowings right now, but at 5.6%, it pales in comparison to those of consumers from other countries. And then investments, yes, we're seeing a pickup in investments right now, but it's still a far cry from what it can be. So during the first quarter, it was actually only 17%, or investments to GDP was 17%. Okay, for 2011, which is the chart on your left-hand side, So just want to see how high it can go. Okay, regionally, you see that the average is much higher than what we posted in 2011. In 2011, our investments to GDP hit 22%, but those in the region were hitting 31%, 30%, except for Malaysia, which is 20%. But just goes to show that we still have a lot of room for investments to pick up. Okay, but notwithstanding our positive view, we think that the market will not go up in a straight line, and this is because of serious problems overseas, unattractive valuations, and share placements recently, which we believe could sap liquidity in the short term. Okay, what are the problems overseas? So the US could have some problems towards the end of the year. Okay, the debt ceiling might be hit again by end of the year. And because the politicians right now are so focused on the election, they have not yet addressed this problem. They also have what we call the fiscal cliff, because by the end of the year, or start of 2013, the Bush tax cuts are set to expire, and certain budget cuts are also set to take place. Okay, some austerity measures are set to take place, and if ever these problems are not addressed, the US could go into a recession. In Europe, well, the problem has not yet been resolved clearly, so no meaningful structural reforms have yet to be implemented, and we believe that it might be difficult for them to implement this. Okay, this is because between the members, there is a significant difference in the economic condition of the member economies. So we always hear countries such as Greece and Spain right now asking for help, whereas Germany is not willing to provide help. Then no flexibility in monetary policy. So usually if countries encounter problems, what they do is they depreciate the currency, or they print more money to pay off the debts. But countries such as Greece and Spain that have problems right now have no liberty in doing that, because they are part of the 17-country euro. Okay. Then right now we know that Spain and Greece essentially cannot access the capital markets anymore. Nobody wants to lend them money. There's no confidence. Okay. And finally, before they are lent money, they have to implement harsh austerity measures. They have to increase taxes. They have to do budget cuts. And this is not good. It sends the economy even to a weaker state. Because obviously, if you cut your spending at the time when you're already entering a recession, you go into a deeper recession. Okay, so we don't expect conditions to improve there anytime soon. In China, they're highly dependent on exports and highly dependent on investments. So right now, those two sides are being hit. And also they have this issue about a housing bubble, and that's still a concern at this point. Okay, the Philippine market valuations are also not attractive. So if you look at the range, or the PE band range, the market currently is trading at around 16.2 times PE. So during the past 10 years, this is the high end of the range. Okay. And if we compare the Philippines also to other markets in the region and the US, and also the BRIC economies, we are quite expensive. Okay. So foreign investors might think twice about coming in if they see this, that we are expensive, relatively speaking, at this point in time. Okay. And finally, you have share placements that could sap liquidity. So during the past 2 months, a lot of companies have raised capital. Okay, you have BDO raising 43.5 billion pesos through a rights offering. Then you have URC raising 7.4 billion by selling their treasury shares. Ayala Land raising 13.6 billion. Ayala Corp raising 6.5 billion and Pure Gold raising 6.5. So all in all, they raised 77.5 billion. Okay. Nevertheless, our strategy is to stay invested. We recommend investors to stay invested because we believe that we're still in the early stage of the cycle and fundamentals will eventually catch up with valuations. And pullbacks that could take place because of the problems that we talked about are opportunities to actually pick up stocks. First, because we believe that the Philippines is resilient to developments overseas. We've discussed the factors earlier on. And share placements are only short-term drags as proceeds will enable these companies to fund expansion. So I'll talk about the first one right now. So we did a scenario analysis. So earlier this year, we did a presentation that it's a high conviction call. We said that we believe that the PSEI has what it takes to hit 10,000. And the question is, I guess the biggest question is, when can this happen? And we did another scenario analysis this time around. I mean, with the PSEI currently at 5,002, 5,1, how long will it take for 10,000 to be hit? I mean, are we at a phase similar to the dot-com bubble where, you know, it's been more than 10 years, but we don't see a new high in the NASDAQ, something like that. So we did 3 scenarios. The first scenario, we assumed that EPS growth going forward would be somewhat disappointing. It would only grow by 10%, which was the growth rate that it achieved during the past 5 years. Okay, pre-Pinoy era, let's say. Because EPS growth will only hit that phase. All this excitement about increasing government spending, higher investments will not materialize. And because of that, we assume that PE would go back to the historical average of 14 times, okay, because of the disappointment. So how long would it take the PSEI to hit 10,000? 8 years. And the implied compounded annual growth rate would be 8.7%. Okay, this is bad, but 8.7%, if you think about it, is not bad relative to the other investment products that you currently have access to. Like right now, you have to invest for maybe 10 years to earn 7% or 6% in a bond. So investing in stocks would still be a good alternative to bonds, even if it gives you a return of 8.7% per annum. Scenario 2 is assuming that what analysts right now are projecting will materialize, which is EPS growth of 12%, and we maintain our current forward PE of 16 times because indeed what we are expecting materializes. So in this case, which is more or less in line with analyst expectation, it will take around 5.5 years for us to hit our 10,000 target. So the implied annual return would be 12.9%, which is really not bad. Finally, if we take on the most bullish scenario where earnings growth would pick up to around 15% per annum, companies will price positively because of all these huge investments that come in and government spending really ramps up. We think we could also re-rate in terms of PE. The market could trade at 18 times PE. And if this happens, we could actually reach 10,000 in as short as 3.5 years, implying a compounded annual growth rate of the market of 20.9%. Okay, we think that the likelihood for us to actually hit dual scenario 1 is very minimal. There's a greater chance that we'll do scenario 2 or scenario 3. So we are quite optimistic. Although we're expensive right now, we think odds are more in favor for us to stay invested and eventually share prices will go up, leading to higher returns for the investors. Okay, share placements as far as they're concerned, well, we really thought about this, and although they're negative in the short term because those investors who want to buy these stocks have already bought them through the placements. But the question is, are the companies placing out these funds because they want an exit strategy or because they want to fund an expansion plan? And if you see the use of proceeds, most of them really will be for expansion. Okay, so BDO, they raise the funds to address their capital adequacy problems, and this will allow them to grow their lending portfolio. Okay, URC actually sold treasury shares, and when a company shares treasury shares, the funds go to the company's coffers. And URC said that they will use the funds for potential acquisition and for general corporate purposes. They just want to build a war chest. For Ayala Land, okay, Ayala Land is actually, they sold primary shares or new shares. So initially there will be a dilution of around 5%. But Ayala Land has said that they will use proceeds to increase their land bank. Okay, and they might use some of the funds for the planned acquisition of a stake in Ortigas family's OCLP Holdings Inc. Okay, so which we believe is a great opportunity for them. And Ayala Corp also sold its treasury shares, so the funds will go to them, and they will use the funds to help their investments in new ventures such as transport, infrastructure, and power generation. Okay, so they said over the next 5 years they plan to invest around $1 billion US. Okay, only Pure Gold, whose funds are raised, will go to the hands of the major shareholder. Okay, but everything else, the funds will be used for expansion. Okay, so our model portfolio. Well, for those of you who are following our Calling the Shots portfolio, we are maintaining our bias on growth. We still like the same stocks, but we are adding 2 stocks to the list, BDO and SM Prime. Okay, BDO, we have a positive view on the capital that was raised. It will allow them to continue growing, and that capital will, the stock is actually quite cheap, and we think its underperformance right now is actually an opportunity to accumulate the stock. SM Prime, we believe it's going to be a beneficiary of the positive outlook for consumer spending, given its position as the dominant leader in mall operations. Okay. Other stocks, well, I know that a lot of them are already expensive, and I have my buy below price. A lot of them are trading above it, but there might be an opportunity right now to accumulate them. As you know, stocks that had share placements are actually being sold now. Stocks such as Ayala Land, Ayala Corp, Pure Gold. So we think these are exciting times, and they might give us an opportunity to buy them again, okay, for those that missed out on the opportunity to buy those stocks. Okay, so in summary, it's more fun investing in the Philippines. Okay, Philippine market has done well so far this year, and it should continue to do well in the future due to its resilience of its customers or consumers, the government's ability and willingness to spend, the growing momentum of PPP projects, among other things. And there are no signs of a bubble yet, given the absence of excessive borrowings and investments. Okay. We admit that it won't be a smooth ride up due to serious problems prevailing overseas, expensive valuations, and numerous share placements that could sap liquidity in the market. However, investors should stay invested. Okay. Fundamentals should eventually catch up with expensive valuations, allowing share prices to continue going up. And pullbacks brought about by developments overseas and share placements are opportunities to buy more stocks. We are confident that the Philippines will remain resilient to developments overseas, while share placements will allow companies to fund expansion plans. Okay. Given our favorable view on growth, our model portfolio is comprised mostly of growth stocks. We also have some high dividend yielding stocks, given our view that these will be in favor in light of low interest rates. Okay. We also added BDO and SM Prime in our portfolio. BDO's stronger capital base should enable it to resume the rapid growth of its lending portfolio and allow profitability to reach new highs in 2015. Okay, valuations are also attractive. For SM Prime, we expect it to be a major beneficiary of the favorable growth outlook for consumer spending in the country, given its position as the dominant market leader in the mall business. Okay, thank you very much. That ends my presentation.